despite multiple reports highlighting Berlin's skepticism. Rufo spoke with Bloomberg's Francine Lacroix on the sidelines of the Munich Security Conference.
For France, it's totally critical to be involved in big and important European projects, and so we stand for it. And I mean, this cooperation, the industrial part is difficult, we know that, but the responsibility of the governments, of the leaders, is to try and push very, very much, because it's not only a signal for France and Germany, I mean, it's for Europe, and we need to take our responsibility and to do, I mean, anything we can to deliver.
On top of threats from Russia and China, Donald Trump's America First policy has made Sweden warm to the idea of adopting the euro. Swedish lawmakers say the switch will give the country a seat at the table when it comes to pan-European monetary matters. Joining me now is our reporter, Charlie Duxbury. So this is an interesting development in Sweden. What has changed there since voters actually rejected the euro in a referendum going all the way back to 2003?
Yeah, hi. Well, I think what's new here is the geopolitics of it all. I think you're seeing some lawmakers in Sweden are looking at the rise of China, they're looking at nearby Russia, and most recently, and probably most significantly, the US claims on Greenland, and they're thinking that binding themselves more tightly to a big economic bloc in the form of the Eurozone might be a good move at this stage.
And it seems to be also a possibility from the government as well. The finance minister backing an inquiry into euro's adoption. Business leaders seem to be on board too.
Yeah, so the finance minister has opened the door to an inquiry, probably after an election in September, if she's still in power then, to look at the pros and cons. Obviously, there's the geopolitics, and then there's the economic arguments for and against, which they think need another look.
Yeah, what about the general public? The public happy to subscribe to the euro and relinquish the krona?
There is still quite a lot of caution when you ask people here how they feel about adopting the euro. I think memories of the Eurozone debt crisis are still fresh in people's minds here. So if lawmakers decide to back a shift to the euro, they will need to convince voters that the Eurozone isn't the same as it was back in 2010 and that it's a more stable place today.
Yeah. Charlie, thank you so much. Bloomberg's Charlie Duxbury on our Bloomberg Priority feature today on Sweden and the potential, or they're looking into the possibility of joining the euro. Now, coming up, a new episode in the battle for Warner Brothers could be opening after Paramount's amended offer. We'll review the latest twist in the drama just ahead. This is Bloomberg.
Crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked, and we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ. Mondays on Bloomberg. February 24th, as affordability, immigration, and national security dominate the headlines leading into the midterms, President Trump will deliver his State of the Union address. Balance of Power will bring you live global coverage starting at 8 p.m. Eastern. Earnings season is here.
Let's get back to the earnings story.
Get all the details that you're going to need to start the trade.
Bloomberg is first to break the numbers.
A bunch of earnings, pretty agricole.
Earnings from Heineken, ABN AMRO reporting as well.
Fantastic reporting from you and the team.
With the smartest insights.
We've delivered again record results.
If we take a step back and look at the yearly results, the income is stable.
Our earnings interviews continue. Lots of really contrasting conversations.
Continuing coverage on Bloomberg.
Welcome back to Bloomberg Daybreak Europe. Now to some corporate news that we're following today. Dubai's government has appointed Isa Kazim as chairman of DP World, an executive who holds several roles at the heart of Dubai's financial sector and one with a track record in handling delicate situations. This after Chief Executive Sultan Ahmed bin Sulayem resigned after his alleged links to disgraced financier Jeffrey Epstein emerged. Yuvraj Narayan will take over as DP World's CEO. The UK is to crack down on AI chatbots sharing harmful content, pledging to ensure they comply with laws designed to protect children online. Speaking later, Prime Minister Keir Starmer is set to say all AI chatbot providers will need to take responsibility for moderating and preventing illegal content in line with the Online Safety Act. Hapag-Lloyd is in advanced talks to acquire Israeli competitor Zim Integrated Shipping. As sources say the parties are expected to sign off on a deal as soon as this week after several months of negotiations that Zim held with potential buyers. The Israeli business daily Kalkalis says the sale price would exceed $3.5 billion. And Bloomberg has learned that Warner Brothers Discovery is considering reopening sale talks with Paramount. Sources say Paramount submitted amended terms last week. The move could spark a fresh bidding war with streaming giant Netflix. Let's go to Bloomberg's deals editor, Manuel Begori. Once again, Manuel, what do we know about Paramount's amended offer, though?
Yes, Giovanna, it's another episode in this saga, and very interesting. It's kept us on our toes for so long, right? But another twist and turn here with Warner Brothers board for the very first time trying to see whether it could consider the potential offer from Paramount as superior, right? And that opens potentially a new chapter in this, given that they have an agreed deal with Netflix. We were able to learn that Paramount came with kind of like a tweaked offer, so to speak, in which they would offer, among other things, to pay, for the fee to Netflix in case that deal, the agreed deal, were terminated. $2.8 billion right there. On top of that, they would also backstop the debt refinancing by Warner Brothers, and beyond, they would also try to close the deal and get all the regulatory approvals by December 31st, by the end of the year, which obviously highlights how confident they are in closing this deal. Yet, it remains to be seen whether or not they will engage and Warner Brothers will actually make the step forward to re-engage with Paramount. That would be potentially the next step, in which case they would have to first notify Netflix as well.
Well, this is the thing. Doesn't Warner Brothers already have a binding agreement with Netflix? So how does this work, and how likely is it that the renewed offer is going to change their view of who to go with?
Yes, indeed. It's not the first, it won't be the last time that something like this happens. Obviously, there is consequences because, as you well said, Jumana, there is a legal binding agreement on the table. So for that to be terminated, obviously the parties will have to rearrange and obviously compensate Netflix over doing that. And that's why Paramount has offered to potentially, take care of that, among other things. Obviously, there could be more twists and turns because Netflix could potentially come back with another offer. Who knows, given all the twists and turns that we've seen here before. But yet, it's something that we've seen in takeovers before, especially on these bidding wars.
Bloomberg Deals editor Manuel Baigorri, thank you so much for bringing us the latest twists and turns with the Warner Brothers story. All right, let's check in on markets. It is a holiday in the U.S. today. It's President's Day, so we will not see cash trading for these equity indices, but futures are trading. And, of course, we did get the slightly softer than expected CPI print come through on Friday, so we've seen further interest rate cuts expectations added this year. They're about 60, a little more than that, 60 basis points worth of rate cuts priced in for this year. The other big story, of course, was the tech rout that we had last week. NASDAQ ended the week down 2.1%. Today, things are stabilizing both for the NASDAQ and the S&P as we head into another week of big data to watch out for, PCE on the docket, as well as the Fed minutes. European markets, too, inching towards positive. And this week, as we said earlier on in the show, watch out for a lot of the earnings coming through from miners. And many of them are actually on the FTSE 100. The FTSE, one of the outperformers last week. So the run-up in precious metals and industrial metals should be benefiting some of the mining stocks that we'll be reporting throughout the course of this week. And then take a look at Brent today. We are just shy of $68. Geopolitics still very much in focus. Another round of negotiations set to take place between U.S. and Iran. The Israeli Prime Minister over the weekend setting out his conditions for what he would like to see in the deal. So let's see whether anything comes out of those Geneva talks in the next couple of days. We probably do have a couple of dollars of geopolitical premium priced in to our oil is trading. And then gold, just shy of $5,000 here. We're about 0.9% weaker. And this after we saw some profit taking on back of that weaker than expected inflation print on Friday. I will tell you that in terms of performance, gold has now regained half of the losses since that rout. And at one point, we were dragged below $4,500 per ounce. So we're back up to $5,000, regained about half of the ground loss, seem to be stabilizing around $5,000 here. But that is where we are and getting set up into the week ahead. Right, plenty more coming up. This is Bloomberg.
Fixed income fix. Watch Bloomberg Real Yield every Friday at 12 p.m. Eastern right here on Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg.
Earnings season is here.
Earnings season is upon us.
Can they surpass expectations?
Bloomberg is first to break the numbers.
Taking a look at Starbucks.
Meta with the outlook.
eBay also reporting earnings. More earnings to get through.
With the smartest insights.
You start the year at 22 times forward earnings. You're just going to have a more sensitive market.
We're probably going to have another good earnings season.
And our conversation continues here on Bloomberg.
Continuing coverage on Bloomberg. Context changes everything.
Astonishing day for U.S. technology.
developments shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Welcome back to Bloomberg Daybreak Europe. Let's talk you through some of the key charts that have been on my radar, especially since that CPI print on Friday came in slightly weaker than expectations. Let's just take a look back at the trends. And what you can see is slowly, we seem to be trending towards that 2% mark. This is the super core, i.e. if you take that inflation print and remove all of the extremely volatile components like food and energy and others, you can see that the trend is slowly drifting lower, which actually there are two sides of the same coin. It's still at 2.6%, so that gives ammunition to the hawks to say that rates still need to be on hold, whereas the fact that it's drifting lower is giving ammunition to the doves to say that we need to be mindful of the fact that inflation is quite muted at this point, month to month growing at 0.2%. So that's your inflation chart. Of course, the big market phenomenon last week was the tech rout that we saw. This chart really puts things in context. Take a look at that ETF tracking software stocks, that yellow line, down significantly over the course of the year, down more than 23%. But basically the drop all happened in the course of the last couple of weeks, and just tells you about how investors are really beginning to price in AI disruption in certain sectors of the economy. Software here, the main one. And then you have a few specific names. You have Amazon in white and then Microsoft in blue as well. Also some of the names that are being hit because many of them have announced these huge capex spending plans for 2026. So that's your AI chart. And then switching over, let's also talk about Fed. We get many Fed speakers coming up this week, and I think the market probably is going to pay a lot of attention to that. We have the minutes coming through as well. And what's interesting here is we have a sentiment indicator. It's, I guess they just track the language that's coming through from a lot of these policymakers, whether it's hawkish or dovish. And what's happened recently since the beginning of the year is a lot of the language coming through from policymakers has turned more hawkish. Many of them are saying that there is no imminent need to start cutting interest rates. The likes of Beth Hammack, for example, saying that she expects rates to be on hold for the foreseeable future. So the language is turning more hawkish, but the pricing is still around 60 basis points worth of rate cuts. So that's your charts. And in terms of major risk events for this week, just to recap, Asian markets are closed for Lunar New Year. Chinese markets are going to be closed for the next week or so. A lot of mining earnings to watch out for. BHP today, Antofagasta on Tuesday, Glencore coming up, Rio towards the end of the week as well. So keep an eye out on those earnings. And then on Wednesday, UK CPI print to watch out for as well. There will be a reweighting of that basket. And Robinhood wants to get more retail investors on board in Britain. We'll speak to its UK president.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras. The lens that I look at it through is essentially how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
You are up, bringing you up-to-the-minute aerospace news whenever and wherever it happens. I'm Guy Johnson at the Dubai Air Show, and this is Bloomberg. Good morning. Monday the 16th, a holiday in America, but this is what we're talking about. This is what's on the agenda. Stocks enjoying inflation Goldilocks. Ironically, gold isn't. Japanese growth stalling in the fourth quarter. Get ready for the Takaichi turnaround. And what really happened in Munich? Ollie Crook is here with a security briefing and a market check.
Yeah, that's right, Guy. Thank you so much for welcoming here in London. Looking at the futures this morning, shaping up thus. S&P futures up about 1/5% this morning, 68.64, the number you're looking for. You're not going to get any cash trading this morning. However, we will be looking at the futures throughout the program. Futures in Europe, getting another bid here, about 1/10 of 1 percentage point here. And as you say, Guy, gold down 1%, breaking below 5,000. The invincible gold tray taking a little bit more of a beating today, down by about $50 a trade. The countdown to the opening trade starts right now.
Morning, how you doing? Monday morning, America's out, Asia's out pretty much all week. It's going to be a quiet week from that point of view. However, there is a lot to think about and a lot to still price in. Inflation data out of the United States on Friday came in, you could argue, better than anticipated. We get more of that this week, though, in terms of the PCE story. But was it as good as it looked? Equity markets are loving it. Goldilocks looks to be in charge of the narrative. So I was saying, ironically, gold is a little softer on that. Bonds obviously liking this story as well. But take a look at the front page of the Wall Street Journal this morning. Inflation is coming back, apparently. You've got the gasoline story, which you need to fold into that data as well. Are we convinced, Ollie Crook, that inflation is dead? Or at least Goldilocks is in charge?
Yeah, well, that's the big question, Guy. And I think that the question also going into this is looking at sort of the labor data that we've been seeing out of the United States. You got a very strong print for January. However, you look back at last year, they only netted something like 180,000 jobs in the U.S. economy. They are, according to our research, one of the weakest years for job market creation in the United States outside of a recession since 2003.
So I think that's interesting in as much as what we are seeing is actually quite a strong economy from many points of view. The inflation story is coming down. You've got the gold story. This is in the United States. Sorry, you've got the labour market data looking good. Does this last into the midterms?
Yeah, and there's another question for that. And I mean, is 2%, for example, the Fed's target? Is that low enough for President Trump in an election year in 2028?
That's the question. He wants gasoline prices, but they've been coming down. They've been going up. If you take a look at what is happening with the story around chips, you've got this huge kind of surge in chip pricing at the moment that's affecting everything. That's going to push consumer electronic prices up. Can Trump really bring inflation down enough to get the Republicans with a big enough boost going into those midterms, I think is the question. But the U.S. economy feels like it's doing okay right now.
And on the question of inflation, can you see some capitulation on, for example, tariff policy? That is something that we've been seeing some reporting on. Obviously, that would have a read across to the Europeans. Steel and aluminum, still the big issue for the Europeans, trying to get that 50% down to 15 if they can.
Plus, for the stock market point of view, the AI story is still out there. So this morning, everything looks kind of hunky-dory. Does that last? When do we next see another sort of AI impact on another sector, which is what we watched all last week? Let's talk quickly about what is happening with the Japanese data this morning. So you've seen a weaker yen coming through. You've seen a steepening of the Japanese curve. Front-end yields coming down, back-end yields going back up again. You've got very weak data coming out in the fourth quarter. 0.2. The market was looking for 0.6 in terms of the GDP read.
Massive disappointment.
Yes and no.
Yeah.
Okay.
This is the classic Guy answer.
Yeah, precisely. Yes and no. So If you were Takeichi and you wanted to come in and get this economy motoring again, you wanted to deliver the fiscal story, you wanted to deliver better data going forward, what's the best thing that can happen to you just as you arrive?
Yeah.
A really weak print.
Absolutely. I mean, it gives you sort of an underdog sort of narrative that you can sort of index on. But the question is, I mean, I think there's a question also, Guy, and I think this is one that you pose from time to time and that we should maybe pose more broadly in the market. I mean, debt. I mean, debt in Japan already. If you're talking about fiscal stimulus, you're talking about cutting taxes, you're talking about cutting back revenues for government revenues. I mean, when is that going to be coming to the fore? I mean, it's a conversation, obviously, in Europe. It's a conversation in the United States, and it's certainly a conversation in Japan.
It will be at some point, but I think she's going to be given enough wiggle room to operate with for at least a while.
Yeah.
And therefore, she's going to spend more, maybe cut taxes a little bit more, try and get self-sustaining growth going. Wages are pushing higher as well. Is the BOJ going to react to that? Would it be good if the BOJ reacted to that?
Yeah.
Anyway, this morning the market reaction is yen down, curve steeper. Again, Takeichi's coming. How long does that trade last for? Okay, the question I've been basically warming up to all morning. What happened in Munich?
Yeah, well, that's a very good question, a very complex question. A lot of things happened in Munich. I mean, I think for one thing, again, we got the speech from Marco Rubio. That was the sort of hotly anticipated thing. I think everybody, every European policymaker, world leader, defense CEO, everybody was sort of tense with anticipation to see what kind of tone Marco Rubio would strike in Munich. And what he struck was something that was pretty down the line. It basically didn't compromise on any of the MAGA American Trump values. It's a speech I think Trump could be fairly pleased with. It is one that also the Europeans could take as a win because it wasn't sort of disastrous. That being said, I don't think anything basically changed over the sort of the weekend in terms of American posture towards Europe. I think that one of the things that I found most interesting in the discussions there is we're talking about European sovereignty, right, for defense in terms of spending, but also building out more of this kit, because can you be dependent with an unreliable United States for all of your software updates, for all of your sort of air defense, all of those sorts of things? And it's a fairly rare event, I think, for world leaders to talk openly about nuclear deterrence. Friedrich Merz went to the stage. He said he's been having, private talks with Emmanuel Macron about nuclear deterrence. Germany is not going to change its own posture. That was sort of the headline. But talking about that publicly, Guy, is a massive signal.
You talk about, let's talk about the combined package. Can Europe, though, deliver its own defence quickly enough? Can it produce a stable enough defence deterrence that it doesn't need to rely on the United States? How quickly is that possible by? Because the other thing that came out of this to me is that we're still building 4 tanks. We're still building multiple fighter aircraft. Europe talks about getting its act together, but it's still not focused enough. And it's that focus. We still want to build a French-German aircraft. We still want to build. We still want to do our own little thing, but we've got to figure out how to do it together.
And we're also failing to do that. I mean, the FCAS, this is the joint project between the Germans and the French, getting that fighter jet off the ground has been basically impossible. They've been trying to do that for many, many, many years now. I spoke to the German defense minister. I said, can we basically call this project dead? He goes, not quite yet. I mean, not exactly a rousing sort of degree of confidence that they're going to get it over the line. But he did say that basically, even if it does fail, it's not going to be the end of cooperation between the Germans, between the French in terms of military and industry and building that out. But anyway, a lot to talk about, a lot to unpack throughout the program, and we'll certainly be doing that with a number of guests. Let's tell you what we've got coming up in the show today. We've got John Turek, the CEO of JST Advisors, Nicholas Brooks, Head of Economic and Investment Research at ICG, and Natalia Lipakina of JP Morgan Private Bank, and Marcus Waver of Franklin Templeton. Guy.
Okay, let's talk about what else we need to know this busy Monday morning. The UK housing market remains soggy at the start of 2026, with lots of homes on the market, making it a good time apparently to buy. The number of homes on the market is at an 11-year high. This according to Rightmove. With rates coming down though and wages picking up, estate agents think the lull could be short-lived. Volkswagen reportedly plans to cut costs by 20% by the end of 2028. This, according to reporting from Manager magazine. The CEO and CFO presented the plan to senior managers back in mid-January. The executives did, though, not specify which particular areas the business would be affected. And Warner Brothers Discovery is said to be considering reopening sale talks with Paramount Skydance. Bloomberg sources say Paramount submitted amended terms last week, trying to topple the existing deal with Netflix. The new offer includes Paramount covering a $2.8 billion fee owed to the streaming giant if Warner terminates its agreement. Warner has agreed to sell its namesake studio and HBO Max streaming businesses to Netflix in an all-share deal, Ollie.
Guy, the deal comes back. Well, coming up, we'll get you some of the key interviews from the Munich Security Conference, as we were just discussing. A lot to unpack. We were lucky enough to sit down with the U.S. Secretary of State Marco Rubio and the German Defense Minister. We'll bring you that a little bit later. Plus, Fear of the memory shortage makes its play in the AI trade. And up next, we'll talk about Fed bets and the market risk going into this week. If you have any questions, as ever, for the guests here, message us on IB plus BTV Go. This is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Verdon in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Anne-Marie Hordern in Davos, Switzerland, and this is Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Earnings season is here.
Let's get back to the earnings story.
Get all the details that you're going to need to start the trade.
Bloomberg is first to break the numbers.
A bunch of earnings, Crédit Agricole.
Earnings from Heineken, ABN AMRO reporting as well.
Fantastic reporting from you and the team.
With the smartest insights.
We've delivered again record results.
If we take a step back and look at the yearly results, the income is stable.
Our earnings interviews continue. Lots of really contrasting conversations.
Continuing coverage on Bloomberg. February 24th, as affordability, immigration, and national security dominate the headlines leading into the midterms, President Trump will deliver his State of the Union address. Balance of Power will bring you live global coverage starting at 8 p.m. Eastern.
All of our software companies are using AI, they're selling AI, they're developing AI. AI is software. Software is AI if you do it right. So to think that all software is the same, we think is, they're missing the mark a bit. We think this could be a really exceptional buying opportunity.
The view from Thoma Bravo, which has a lot of software stocks in its portfolio, talking there about saying Public markets maybe are not being discerning enough as we see this recent software sell-off rip through markets. It comes, obviously, as we've seen that story, wreaking turmoil across markets. The AI story absolutely front and centre last week. Does it last? Are markets being too indiscriminate? John Turek, CEO of JST Advisors, joining us now. John, what do you make of what we saw last week? This is the story. You can park the macro data in some ways. We'll come back to it in a minute. But the fact that everybody is struggling to understand the impact on the software sector, on the logistics software, on the legal sector of AI is causing problems for everybody at the moment. What's your view?
Yeah, no, and I think it's interesting even from a macro perspective right now, where we're having this transition from, I would say, the AI spend, which was the last 2 years in terms of the CapEx boom, in terms of the hyperscalers, to now where I think we're transitioning thematically into the AI impact. And I think that, for the software sector and kind of macro writ large, we're just widening the distribution of outcomes. And I think that, for a sector that was priced quite expensively in terms of valuation, introducing, a pretty material left tail pricing into the distribution, even if that delta, so to speak, is not so high, just that in terms of rate of change going from something like 0 to 5%, I mean, that's a very meaningful impact in price terms. So I think what the market is trying to, get its head around now is less focused on sort of the outcome of all this, which I think, the Thoma Bravo gentleman was talking about, but more what's the distribution around all of this. And I think that's, both sides of both tails are going to have a big impact in terms of pricing going forward.
Can you analyze this from a macro point of view, or do you just have to get bottom up and look at individual stocks and sectors? What's the best way of looking at this?
Well, I think it's hard to not do it from a macro perspective at the moment, because we just have so many unknowns in terms of what this impact is going to be. I would think even, the people at Anthropic, the people at OpenAI, the people at Gemini, they don't really have a good sense of what 12 to 18 months looks like. So it's very hard to have a high percentage view in terms of that this specific equity or this specific credit is more immune than another. And I think that's why the market is like painting such a broad brush with a lot of these names, because it's just very hard to know kind of which name is safe and which name isn't.
And how close do you think we are at being able to sort of get to a sort of large unifying narrative around sort of the AI trade, something that is actually executionable? And how do you think that has shifted in the last 2 months for you?
Yeah, well, I think we kind of have it, right? Like the market is saying that sort of the old industries are more immune, and the newer industries, aka software, capital light businesses versus capital heavy businesses, we've kind of had a massive re-rate over the last few months in terms of which the market is rewarding. And in a way, I don't think that this, narrative is over. I think it probably, has legs as the market is viewing that industries that, are much more technology oriented and much more susceptible to sort of, further AI advances are just more at risk than companies that, industrials, cyclicals, things of that nature, sort of the old economy. Those companies are more likely to see sort of increased operational leverage from AI advancements, but doesn't really change in terms of a moat or in terms of the product that they're developing. Whereas, some of the, what I would call like the new industries, it's just very unclear, what all of this looks like in a 6 to 12 month basis, considering where we've been over the last 3 months. I mean, I think it's quite telling since we've had this new advancement with Claude and Anthropic. The NASDAQ as a whole hasn't made a new high. And we've really associated that, tech equities have sort of incrementally made new highs as we've made AI advancement. And that kind of inflected over the last few months with this recent development from Anthropic.
And thinking about the sort of dueling AI narratives, the risks, of course, of overspend, that was something that really gripped the attention of the markets for a very long time. Now, of course, the sort of risk of wipeout in a number of different industries. How do you hedge against, if you want to hedge against both of those risks? You want to step out of that a little bit. I mean, of course, we saw a lot of movements into commodities, gold, silver. That obviously carried its own kinds of risk. How do you hedge?
Yeah, so I think actually the interesting way to play this is the front end of the yield curve in the United States. I think that the increase, both at the same time, the increased tale of that, this technology is too good and it could be a labor displacement episode, or this technology is sort of not living up to the hype and it could be an overinvestment cycle. Both kind of favor, I think, front-end yields lower in the U.S. as the market sort of has to weigh that, if this overinvestment, there could be a turn in the cyclical cycle. And if this is sort of this, nonlinear advancement in technology, it could have labor market ramifications that the Fed would likely have to address down the road. So I think that, probably cleaner than the precious metal trade, which I think has other components to it, likely more geopolitical, likely more tied to the Chinese trade surplus. I think that the front end of the U.S. yield curve is actually pretty well positioned to hedge these sort of this advancement.
Okay, so that hedge kicks in if we see a problem with maybe this AI build-out trade. What happens in the slightly nearer term, though, if we get, for instance, inflation reaccelerating? What do you make of Friday's number? Do you think inflation really is under control? Do you think it continues to come down? I'm reading lots of stuff at the moment. You look at what is happening with memory prices. You look at what is happening with the bounce back in gasoline prices. The point to maybe inflation picking back up again, John, from this point on.
Yeah, so I think that there's obviously risks, given some of the surges were happening, given that we're now going to be sort of in the teeth of the peak tariff episode, as well as the peak of the, big beautiful bill impact in terms of tax refunds coming. But I think bigger picture, the inflation distribution is relatively well anchored. And the reason I say that is less from a micro perspective, but more from a macro one. And something that I, kind of been emphasizing in my client notes is you really have three vectors that contribute to inflation on a much more sustainable, durable fashion. You have energy, housing, and labor. And I would argue, at least right now, absent a geopolitical shock, we have housing disinflation baked in the cake. Labor is obviously not showing much of an inflationary impulse, given the wage growth story, given the low hiring rate. So I think bigger picture, I'm not sure that, we're going to two in a hurry. I know there's some who forecasted that. I know some who forecasted, much higher outcomes. But I think it's a relatively contained picture and not so much a risk to the fixed income being a hedge to risk asset portfolios.
But, John, we've already got two cuts priced in from the Fed. Are you suggesting there could be more than that?
Yeah, I think there could be more. I think that, the baseline for me is that the Fed in their SEP from December basically baked in a cut, assuming that the data was going to be very good and inflation would be somewhat sticky, right? They assumed that the unemployment rate would end 2026 at 4.4% and that core PCE would end the year at 2.5%. I think that if I had to look at it, I think the risks to both those forecasts are probably more towards the dovish side. And I know that there's one coming, even if that sort of rosy outlook was realized. So I think the risk to the market pricing for cuts is from here is more to less. I think, a little under 2 is probably a better trade versus a little bit above 2, especially in the context of a much more decent payroll print that we got last week. But I think, as a whole, I think, things like the front end of the U.S. yield curve still seem attractive to me.
And sort of evaluating the sort of risk landscape going forward, we were talking about supply chains and all of those sorts of issues in semiconductors a couple of years ago that sort of abated. Now it's sort of coming back to the fore. Where do you put that in sort of the risk in terms of the technology? We're seeing a lot more concern about basically chips not being able to satisfy the demand, not just for the AI build out, but then also those chips in competition for all the other things that we need it for in the economy.
Right. No, it's certainly a micro risk. I think that, the difference between this sort of supply chain episode versus the one we experienced in 2021, 2022 is the cross currents were very different, right? We were experiencing supply chain issues with oil at over $100 given the Russia-Ukraine war. We were experiencing with a massive, labor market episode in terms of wage growth, going above 5 in the United States, the unemployment rate going to a 3 handle. It was a very different sort of cross current. So I think that, yes, from a micro perspective, this memory impact is obviously going to be with us probably for the rest of this year. The question is it enough on its own to sort of, reawaken the inflationary spirits that we had sort of 21, 22? I think not.
John, in your rate cutting scenario, which part of the equity market benefits most from that?
I think it probably depends on how many rate cuts we actually get. I think, to stimulate, some of the more cyclical parts of the economy that have been a little bit left behind over the last 2 years, given, within the run-up we've had in technology. I think that, if we experience, 100 basis points of cuts, that could be very meaningful to something like housing. that has really been, sort of left in the doldrums over the last couple of years. And I think if it's just, what I would call dots plus one, or, a cutting cycle that's, short vol in a way, that's just, massaging around the edges, getting the policy rate closer to neutral. I think that's probably, more of a general equity market story that favors, favors the larger companies. So I think it really depends on the severity. And then, also I think you have to take the risk that, again, the distribution of outcomes around this technology has increased so much that it's probably also increased the left tail outcomes as well. So, I think in that scenario, it would be just less risk positive.
And John, where does sort of Europe sit in your thinking around all of this? Particularly, we're talking about the dollar. We're talking about also potentially, the euro has been strengthening sort of aggressively. This is the year potentially where we start to see real traction from that German stimulus into the economy and potentially into the equity market. Where does Europe sit for you?
Yeah, I think it's a very interesting time for Europe. And I think, there's two things that are pretty interesting right now, especially from a Euro FX perspective. I think the first thing is that the ECB, despite, inflationary evidence and, exchange rate pressure, is seemingly in no rush to cut interest rates. I think that's pretty telling in terms of conveying their sort of the disposition of their reaction function. And then I think, the Greenland episode, as fleeting as it was, I think was very telling in terms of how the market wants to trade increased geopolitical risk between the United States and Europe, in the sense that the second derivative seems very relevant here. And the market assumes that the more pressure Trump puts on Europe, that means the more possible future integration we're getting, the more EU summits we're going to have. And I think the market, especially from here, really has to, entertain, even if it's not the highest likelihood, that if Europe does have further integration measures, it's just going to be very bullish to currency. Just given that it's coming from a low base in terms of, getting anything really done on the policy front in Europe. So I think Europe sits at still like a very interesting position into this year, especially with the backdrop of German fiscal going on.
Well, John Turek, CEO of JST Advisors, thank you so much for your time this morning. He brings up the Greenland moment, and as you can imagine, the Greenland moment was something of high conversation over at the Munich Security Conference. One thing we didn't talk about was the shadow foreign diplomacy we're getting from the Democrats who attended there. I caught up with a senator from Michigan, a Democrat, Melissa Slotkin, and basically what are the conversations she's having with those European leaders? Have a listen to what she had to say.
Well, I think there's a lot of us who are here, certainly from the Senate and the House, to send the message that not everyone agrees with the approach that this president is taking, right? That my president is taking, which is kick your allies in the teeth and cozy up to your adversaries. It's the opposite of what many of us were taught and how we lived.
And so I think a lot of Europeans were looking for cues from other Democrats because obviously we've had America first for the last 12 months. They're wondering, is there still another America out there?
What I heard out of the weekend as well was a lot of people asking the question about kind of what happens after the midterms. What happens in the midterms? Do the Republicans lose? If so, what happens on the back of that? Is Trump suppressed as a result of what he has to do? Is he going to focus on those midterms rather than... So there's a lot of questions still around all of this.
Yeah, absolutely. Yeah, well, we'll be talking about that and a lot more, including the Fed bets next. That is going to come up next with Nicholas Brooks, and this is Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Every weekday from 3 to 5 Eastern.
Only on Bloomberg. Context changes everything.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Technology is embedded in every aspect of our lives
and laying the foundation for the future.
From finance to defense, AI to entertainment,
and from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
and the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
So we're going to spend our morning kind of worrying about AI and worrying about what is happening with employment and inflation and everything. Mother Nature is at it in Hawaii. Amazing pictures coming as we've seen a volcanic explosion taking place there. That is a proper volcano.
I mean, I didn't know what to expect when they were going to pull up the images of this, but absolutely. I mean, you know, U.S. equity markets closed. Volcanic activity very active this morning, as you can see there in Hawaii. Absolutely breathtaking images there.
Okay, let's talk about, can we do tectonic plates shifting? Maybe that's the way that we maybe sort of migrate to our next subject. Futures, bonds, let's talk about what is happening with the markets as the tectonic plates shift. Last week, they certainly did shift. We saw equity markets under pressure last week as we watched what AI could do to various sectors, and the market panicked about that, doesn't really know, and that's the problem. We're in a kind of sell first, ask questions later kind of mode right now. This morning, it looks like we're seeing a slightly more positive picture. Maybe we're responding to the inflation data we saw out of the United States, which paints a more benign picture, at least for now. We'll come back to that in a moment. Bonds catching a bid as well. We've certainly seen it's quite a big impact in terms of yield curves, expectations for U.S. rates, maybe getting a little better in terms of rate cuts, if you think that's better. And we've seen that priced into the bond markets across Europe as well this morning. So positive picture for equity markets this morning. Positive picture, Ollie, for the bond market as well.
Yeah, that's right. And there are a number of things we'll be paying attention to throughout the week. The week book, let's take a look with what's happening throughout the week. As we were saying, you know, U.S. Secretary of State Marco Rubio, he's in Budapest today. This is yet another angle of the Munich Security Conference that we have not yet discussed. He's gone to Slovakia, going to Budapest. Tomorrow we'll get to the Eco-Finance Ministers meeting in Brussels, trying to sort of get their fiscal policy in order in response to what we've been seeing, particularly out of the United States. And UK policymakers will be watching jobs data on Tuesday, followed by UK CPI. Wednesday, we'll also get the minutes, Guy, from Fed's January meeting on Wednesday. Obviously, those will be very closely watched as ever.
Yep.
And Thursday, Euro area consumer confidence and a bumper earnings day across the day on Thursday and Friday. Also, U.S. PCE. Is that enough for you, Guy?
That's enough to keep me going, certainly throughout the week. I thought our last guest was really interesting. He talked about the fact that Trump putting pressure on Europe means that we get more Europe because Europe panics and therefore figures it's got to be kind of, it's got to get its act together finally. It's interesting there's talk now about some of the Nordics joining the euro, what is happening with Trump and the effect that we're having there, and that will be euro positive. I hadn't actually kind of drawn all of those lines.
Yeah,
but it's going to be fascinating.
But you obviously know how difficult it is to bring Europe together and get any of these initiatives.
You need a crisis.
Together. Absolutely, you need a crisis. The question is the scale of crisis quite as urgent as it needs to be in order to do that sort of thing? That's, of course, what my focus has been for the last 12 months and will be for probably the years to come. Anyway, we'll skip it onto the United States, and inflation data would be a major focus for markets this week. I'd like to dissect some of that with Nicholas Brooks right now, the head of economic and investment research at ICE. S&P. G, looking at what we've seen over the last week, the inflation print from the United States last week, and then looking forward to kind of what we're expecting from the Fed minutes today, give us your sort of appraisal, your sort of grand theory of American inflation right now.
Yeah, I mean, I guess what I would say is I think the market's been a little too calm about these numbers, to be perfectly honest. I think, the market is looking for this Goldilocks situation to continue, and it got a strong labor data last week, and then it got what they viewed as, or markets seem to view as a slightly better inflation number. But if you look at the underlying numbers, they're still really strong. I mean, you're looking at core PCE probably in December coming out this week running at close to 3%. Core CPI is running well over 2%, in the mid-twos. I wouldn't argue that you're anywhere close to where the Fed really needs inflation to be. And at the same time, you're looking at underlying economic growth of somewhere between 2 to 3%. So I'd say the economy is running pretty hot. Inflation is still pretty high. There have been some good things happening. We have seen oil prices come down and energy prices come down. But the underlying sort of structural supply-demand situation, I would argue, is still pretty tight.
So we've done the sort of inflation side of the mandate. Let's do the labor market side of the mandate, because we got a number for January that was very, very strong. That being contrasted, though, with net sort of job creation in the United States last year, which, according to our research, was at the lowest level outside of a recession since 2003. What are you seeing in the U.S. labor market? And is this a Fed that is favoring which of these two mandates at this point?
Yeah, well, I think there is a little bias in the Fed at the moment towards cutting. We've already seen a number of cuts over the past year. And clearly, there is a lot of pressure coming from outside to cut rates. Now, to what degree the Fed bends under that, it's hard to say. My instinct is they probably won't too much. But we are getting more members on the board now that are, biased towards cuts. But when you look again at the labor market, you're looking at an unemployment rate at around 4.3%. That's still pretty low by historic standards. And, the labor force growth is slowing down pretty quickly as well. So, there's a tightening on the supply side. So I would agree that on the demand side, we've seen slowdown. But the supply side has also come down pretty quickly and potentially could come down even more quickly over the next year.
What happens if the Fed cuts 3 times this year?
Well, that would be a little more than the market's expecting.
The market's got 2.5 at the moment.
Yeah, so I think, again, it always depends on why they're cutting.
Okay.
If they're cutting because inflation is under control, but growth is still running around 2%, that's fantastic for markets. Risk assets do very well.
You just told me that's not what's happening.
Yeah.
So what happens, in your scenario, what happens if the Fed cuts this?
I see. So if they're cutting, even though growth is still at a very high level and we're at a really tight thing, then I think we start to see the long end of the curve move up much more sharply. And I think we start to have some wobbles potentially. Long-term inflation expectations start ratcheting back up again. And
could you get a 10%? Could you get a 5% 10-year? How high? You talk about the long end moving up. How much do we see?
Yeah, I think you could get to 5%. I think you could get to. Again, it's not my base case scenario but on the scenario where the Fed is cutting, my base case is they're going to cut 25 to 50 basis points. We might see a slight creep up in the long end, but I'm not betting on them cutting 75 basis points when growth is close to 3%. If they do that, I think no question in my mind, you're going to see a very large spike in the long end of the curve, because at the same time, we have the supply-demand dynamic coming through in terms of the large fiscal deficits, because that has to be thrown in there as well. The fiscal deficit in the U.S., according to IMF stats, is looking at 7 to 8% of GDP. So we're complaining about the UK deficit. We're complaining about the French deficit. They're trying to get their deficits down to 2%. Okay, admittedly, they're not there, but, we're at sort of 4 or 5%. The U.S. is running sustained deficits. It's been doing this for a while at 7, 8% of GDP. It's running its economy close to 3%. If they start cutting rates aggressively at the short end, unless we're seeing move towards recession, the long end goes higher.
Equity markets going sideways. We've had the wealth effects in America being driven basically since 2008 by an equity market that keeps going higher and higher. If it stops, what happens?
I mean, again, my own view, I know there's been a lot of modeling on this. In my own view, I think the wealth effect, it matters, and it has had an impact on private consumption, but at the higher end of the spectrum, obviously. I think if the stock market plateaus, I think people will continue to spend.
Okay.
I think you need a big correction that's sustained, and then I think you'll start to see that hit private consumption and start to hit the overall economic growth rate.
And we've talked about the dueling narratives at the Fed between the labor market and inflation. What about the dueling narratives on AI and the AI trade? Overspend, also just the concerns with the wipeout. These are in some ways incompatible ideas. Where do you sit on that?
I agree, they're incompatible ideas. I think everyone is just very confused. I think people don't understand it yet. And I think, as your previous guest highlighted, many of the people running these firms don't know where it's going. It's creating itself in a way. And it's incredible how quickly AI has evolved just over 6 months. The capacity of these models, what they were doing 6 months ago was something like a toddler might do. And now they're doing something experts might do. So it's moving so fast, I don't think people quite understand it.
So not to sort of compose an excessive sort of doom and gloom scenario on this, but if you have something as powerful as the narratives around AI that basically touch every sphere of human life and every asset class, and there's a fundamental inability to sort of come up with a grand narrative of what the effect is going to be, what kind of risk does that set us up for in a market where there's also been so much euphoria around this for the last couple of years?
Yeah, I mean, in my view, it's rational that we've seen valuation correction, and I think that broadly could continue for a while. I think it will be volatile because we don't have
impact on Europe. We've just come out of the Munich Security Conference. Everybody's terrified. Maybe Rubio calms things down a little bit, but not by much. Europe feels like it's facing an existential threat right now. We're going to get more Europe. We're going to get more summits and a desire to do more together. Are we going to see Europe taking a big step forward in that kind of scenario? Is Europe, it usually does these things in a crisis, facing a crisis big enough to deliver a better European outcome?
Yeah, I think so. I mean, we've seen it already in terms of fiscal spending. I mean, Germany, as we know, has done something they haven't done, in generations. They have massively increased their spending on infrastructure and defense. And I think the other countries in Europe that have the capacity are very serious about doing that. So that is one known, and that is going to support economic growth certainly over the next few years. At least it creates a downside protection. Now, to what degree the Europeans get together and the single market and start working on competition, okay, it's a little trickier, but I do think that there is a real push. I mean, I've never seen, having covered Europe for many years, I've never seen such an impetus and such a desire to work together. And certainly the Draghi report, I think, is being used as the sort of the blueprint.
Yeah. And we're kind of trying to figure out which way around we should read it and kind of what it ultimately looks like. But we'll get there eventually. Nicholas, nice to see you. Thank you very much for stopping by to see us. Nicholas Brooks, Head of Economic and Investment Research at ICG. Talking of the Munich Security Conference, the US Secretary of State Marco Rubio was there, sending a slightly softer message to Europe.
The Vice President said last year very clearly was that Europe had made a series of decisions internally that were threatening to the alliance and ultimately to themselves, not because we hate Europe or we don't like Europeans, but because what is it that we fight for? What is it that binds us together? And ultimately it's the fact that we are both heirs to the same civilization, and it's a great civilization, and it's one we should be proud of. It's one that's contributed extraordinarily to the world, and it's one, frankly, upon which America is built.
Join our culture war. Seems to be the message coming from Marco Rubio. Much more on that interview with Bloomberg's John Micklethwaite next. This is Bloomberg.
At any point in your tennis career, did you say, I've had enough,
and I'm just going to retire at the top. Do you ever worry about that problem, staying too long?
It's a great question, and it's one that I think every athlete finds a different answer to. Mine came a little bit later than when I would have liked. I think stubbornness was a great quality that shaped a lot of my victories, but in the end of my career, I think it became a flaw because I was so stubborn to get healthy, for my shoulder to recover. I was also at an age where just my body didn't recover as quickly. And so for a year or two, that stubbornness got in the way of other great things in my life.
What would you say is the thing you're most proud of having done as a tennis player? Was it winning Wimbledon? What was the highlight of your tennis career?
I'd say consistency. I think consistency is, you can have results and they could, come at various times in your career, but I was consistent for many years, and you have to show up. You don't just show up to play first round of the finals, but you have to show up for press conferences before every match, before every tournament, and just the consistency and the mental wear and tear of showing up week in, week out. So I felt like I consistently showed up for my team, for my sponsors. As I look back, I'm proud of that.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything.
$14 minutes, the equity market open here in Europe. Europe, to a certain extent, is the only market that really is kind of as normal this week. The US is closed today. Lots of Asia closed throughout most of this week. So in some ways, you don't really get a kind of true market test until probably later on in the week, certainly. And that will give us an idea of where we really are. Is the macro data in charge, or is this AI narrative still in charge? Or is geopolitics going to sort of impose itself on this narrative as well?
Yeah, Guy, that's a big question. I mean, again, I think it's just a moment to take a moment to mark the moment. 12 months out from that J.D. Vance speech, which was really the foray, the first time we got MAGA foreign policy for Trump to what that would look like. The next 12 months of our lives was completely overtaken with basically the policy that came from that. And this year, we're all waiting tense with anticipation for what Marco Rubio would say. And the U.S. Secretary of State sort of downplayed a little bit the chances of a meaningful fracture in the U.S. and European alliance if Ukraine loses the war with Russia. He spoke exclusively to us, to our editor-in-chief, John Micklethwaite, at the sidelines of the Munich Security Conference. Have a listen.
The Russians are losing 7,000 to 8,000 soldiers a week. A week. Yeah, not wounded, dead. Ukraine has suffered extraordinary damage, including, overnight, and again, to its energy infrastructure, and it will take billions of dollars and years to rebuild that country. So I don't think anyone can claim to be winning it. I think that both sides are suffering tremendous damage, and we'd like to see the war come to an end. It's a senseless war. In our view, the president believes that very deeply. He believes the war would have never happened had he been president at the time. So we're doing 2 things. So obviously we continue. Look, we don't provide arms to Russia. We provide arms to Ukraine. We don't sanction Ukraine. We sanction Russia. But at the same time, we find ourselves in a unique position of serving as probably the only nation on earth that can bring the 2 sides to discuss the potential for ending this war on negotiated terms. And it's an obligation we won't walk away from, because we think it's a very unique one to have. It may not come to fruition, unfortunately. I hope it does, and I think there are days when I feel more optimistic about it than others. But we're going to keep trying, because that is, in the end, this war will not be solved militarily. It will be, in the end, it will come to a negotiated settlement. We'd like to see that happen as soon as possible.
Do you worry that if Ukraine loses the war, it's going to be a disaster for the transatlantic relationship? Because Americans will say the Europeans didn't provide enough arms, and Europeans will look and remember the meeting in the White House and Zelensky and Trump, and they will blame the other way.
That would ignore reality. Look, Ukraine. No, but I'm not worried about that, because I can tell you that I think history will understand it. But I don't think the war is going to end in a traditional loss in the way people think.
So the words there from the U.S. Secretary of State Marco Rubio speaking to us exclusively on the sidelines of the Munich Security Conference. So, Guy, I mean, listen, again, trying to get both of those sort of audiences, the Trump audience as well as the European audience, trying to bring them together in the sort of words of Marco Rubio. But I think it's also interesting because the things that he does not say, for example, where is he right now? He's in Budapest. He's meeting with Orban. He was in Slovakia. These are not the most sort of EU-friendly nations. And we have had a lot of reporting on with the Trump administration, a lot of contact, a lot of outreach with a lot of the parties that are in opposition in a number of countries, whether it's in the AfD in Germany, whether it's in the UK, and a lot of those discussions. And that's something, you know, that's not traditional.
People are saying his manners are slightly better than maybe J.D. Vance's, but basically the message is the same. Is that what we got in Munich? The same message, just dressed slightly differently?
I think so. I think there is a degree, though, of understanding within the Trump administration that maybe they pushed it a little too far, particularly with the sort of Greenland moment. Some of these officials that I've spoken to kind of off the record, or not off the record, but kind of anonymously on the background of the conference, is basically trying to keep Europe in this space between basically intense urgency but not in panic. And that is kind of where you get action. And even if you ask Democratic lawmakers, you ask Europeans, it was only Trump who was able to get the Europeans to get to 2%, 3.5% of spend on NATO, and they're not the first to push that. Obama was pushing it, but it didn't work.
Yeah, and there's also this kind of cultural angle as well, which I think is really interesting as well. That's what's happening on the geopolitical front. Let's talk about what's happening from a market perspective this morning. Joining us now to discuss that is Bloomberg's Adam Linton. Good morning. Good morning. Last week was amazing. Is this week going to be any different? Are we going to see the AI story fading a little bit? Does the inflation picture, the more benign inflation picture, give us a more positive risk-on kind of momentum? What do you think?
I think, if you take the realms of equities, I think AI is obviously going to be incredibly dominant. We saw from the price action last Friday that once again it's these IT stocks, these communication services stocks, which are slumping. And I think the thing for the market is how much can the rest of the broader tape, offset things. We're negative year to date for NASDAQ and S&P 500. And I've been arguing for a while that, if the big large cap companies can't contribute to the rally, and there's only so much the US stocks can do. And I think people are looking elsewhere, looking towards Europe, they're looking to South Korea. And then, but I think the thing is, though, at some point, these are still, good companies. And I think when they start screening in valuations that become more attractive, that will put a floor into how far we can go. But I think it's AI adjacent or, related to that field is in the firing line. We've seen some of these, asset management companies, these software companies, which are getting attacked. So for now, I think people are just going to park in areas which aren't as exposed to those factors.
And how AI adjacent is Europe? Is it seen as sort of an alternative in this sense, just not touching it quite as much? And of course, thinking about kind of the space of Europe and the sort of buy Europe trade, is that really something that you think is gaining traction with investors?
Well, I think, the thing for Europe is what's been its weakness for the past few years is now actually playing to its strengths. It doesn't have this really solid IT sector. So if you're looking to divert away from some of these AI plays, then Europe is actually a pretty good place at the moment. It's got financials, which are performing really well. It's got industrials. It's seeing all this increased EU spending. So the story for the EU is very different to the US. And, if you take things like the dollar, people are trying to reduce dollar exposure, then, Europe is a good avenue for people to look at.
There is I keep hearing this view, though, that if we see the US go down, if you diversify into the rest of the world's going to be just fine. Because if tech goes down in the States, the rest of the world will be okay. Korea will be amazing because we've still got this DRAM story, this high bandwidth memory story going on. But is that true? If US equity markets go down from here, isn't it just isn't the kind of the Europe, the diversification, just a relative trade? Everything goes down if the US equity market goes down. Is that right or is that wrong?
I think to some extent there will obviously be some element of contagion, but I think that, from a broader macro perspective, this is a relatively positive global growth environment.
Right.
So, even though we have seen a dovish pricing for the Fed, US growth is still good. And looking outside of the US, global growth expectations are relatively high. This is a nice cyclical environment to be in at the moment. So I do think that will contain some of the contagion. And also, if these AI companies can become more responsible with their spending, then it can shake out some of the weak hands, some of the weaker players. Yeah. And, this can, we still can see global equities deliver significant returns, even if the US lags.
Well, Adam Linton, thank you so much for joining us this morning, for your take on the markets and everything that we're watching going into this week. Now let's get your stocks to watch with Bloomberg's Louise Moon. Good morning.
Morning. So first up today, we will be focusing on Hapag-Lloyd, the global shipping giant. Now, they're in talks to buy Zim Integrated Shipping, which is a US-listed but Israeli shipping giant, two of the biggest shipping companies globally, both among the top 10. If you look at their share prices, Zim has really outperformed in terms of share price gain over the past year. So it'd be a real combination of two huge companies. It'd be about $3.5 billion deal. Now, it didn't go down too well with the workers of Zim Integrated Shipping. They're threatening strike action. So Hapag have said, to avoid any negative impact, the workers are in the best interest there at the forefront. So trying to reassure there. Expected to close later this week, so we'll be keeping an eye on that and keep you updated with that. Next up, we're looking at Volkswagen, the German car firm. Now, there's been a report that they're planning to cut 20% of costs. Now, this all comes in the wider context of them dealing with tariffs, a slowdown in demand from China, less demand than expected for electric vehicles. You can see this has been kind of weighing on their share price over the past year at various points. So planning 20% more cost cuts there. And then finally, DSM, they're the company behind a lot of ingredients with skincare, nutrition. Shares really weighed over the past year, and we'll be keeping an eye on them to see at market open if there's more of that.
Thank you very much, Louise Moon. We're going to get the sort of futures check coming up into the open here. We're about 2 minutes or 5 minutes away from the market open. Futures are sort of pointing up this morning, Guy, in the day in which the U.S. market will be closed.
Bringing you up-to-the-minute aerospace news whenever and wherever it happens. I'm Guy Johnson at the Dubai Air Show, and this is Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Earnings season is here.
Earnings season is upon us.
Can they surpass expectations?
Bloomberg is first to break the numbers.
Taking a look at Starbucks.
Meta with the outlook.
eBay also reporting earnings. More earnings to get through.
With the smartest insights.
You start the year at 22 times forward earnings. You're just going to have a more sensitive market.
We're probably going to have another good earnings season.
And our conversation continues here on Bloomberg.
Continuing coverage on Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Anne-Marie Hodern in Davos, Switzerland, and this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
Morning, how are you doing? Monday morning. US markets are closed today. You've got a lot of Asia going to be closed throughout most of this week as well. It's going to be a weird week. Last week was a weird week as well. Most of the week was dominated by the AI trade and what the kind of AI adjacent story meant for many, many sectors. Then we got the inflation data on Friday. That looked okay, certainly came in better than anticipated. The markets took that as kind of Goldilocks, as a result of which we saw a much better session in the United States. We actually went out here, and the US closed a little softer than that, so you're getting kind of not much of a tailwind out of the United States into Monday for Euro. So let's take a quick look at futures just to tell you what is happening there and give you an idea of what is going on. Still a fairly positive picture. Stocks 50 up by 0.3%. Similar story for the FTSE 100. Big week for miners. Lots of earnings coming out of the mining sector this week, so we'll pay attention to that. DAX futures are also up by around 0.4%. So this morning we're coming in with a positive vibe, but in a weird week in terms of what we're going to see in terms of markets being open, plus also all the data we've got to sort of get through. And we're still kind of trying to figure out, Ollie, what's happening with this AI narrative.
Yeah, absolutely. And we'll see if there's a positive vibe for UK home builders today, as we saw, as you mentioned, soggy price activity in the UK building sector in terms of prices going up, not really stagnating effectively. Talking about a little bit of M&A with Hapag-Lloyd in talks to buy Zim, and then Volkswagen. Now, this is very interesting. We're awaiting Volkswagen earnings. They say they're going to cut costs by 20% by the end of 2028. I've got to say, Guy, there have been so many conversations I've had with Volkswagen management when they did all those layoffs and had all those conversations, and I always asked them, are you going far enough? They said yes. The answer apparently is no.
I know we've kind of reached this cathartic moment now. Well, have we, in terms of what we're seeing with the EV trade and what that is going to ultimately mean? People are backing off that. OK, let's talk about these markets. Let's talk about why we are here. The markets are up and running this morning from an equity market point of view, at least here in Europe. We're up by 0.2% on the FTSE 100. As I say, it is going to be a massive week for the miners this week. You're going to see an awful lot of data coming through from that sector. Big focus for the London market. 600's up by around 0.2%. Such turbulence last week generated by this AI trade, single stocks, single sectors getting whipsawed around as we try to understand what impact AI would have on those single stocks and sectors. Do we get a little bit of calmness maybe returning to the market this week? The CAC is up by 0.1%. Big week last week for luxury. Just remember, though, that Hermes, I think, goes ex-dividend today. Just pay attention to that one as well. You've got the IBEX up by 0.4%. We'll wait for the German market to get going. That could take a little while. We'll keep a firm eye on what is happening with the Hapag-Lloyd story. We're going to keep a firm eye on what is happening with the Volkswagen story as well. What will that mean for Volkswagen? Will the market take it positively? And the SMI as well. But as I say, the US market is closed today. You're going to see slightly lighter volume as a result of that. Ollie, what are we seeing in single stocks? What are we seeing in sectors?
Yeah, what we're seeing in sectors pretty interesting this morning. We have the banks up by 1.23%, basically 1.25% banks up this morning. Financial services, not shockingly, up also by about 0.6%. Media doing quite well, up by about 0.6% as well. Technology across Europe up by about 0.5% this morning. When we look at the losers, the second most in terms of the losers are utilities, down by about 0.75%. And Guy, the biggest loser this morning on the S&P, or I should say the Stock 600, Basic Resources, down 1.3% in the early trade. We're going to be watching very closely, Guy, of course, the earnings out of BHP today, a little bit later after the market. And, of course, looking very closely, I think, about the commentary in terms of what we've seen in the commodity market over the last month. Some absolutely remarkable moves across, whether it's silver, gold, platinum, all the entire, basically, the complex.
Gold's below 5,000, which I think is interesting. There's some nice pieces being written about gold at the moment. People talking about the fact that it's basically behaving like a tech stock. In fact, it's moving pretty much in line with the technology sector.
Gold,
yeah, precisely. It's become a retail trade, and therefore the relationship back in maybe to that kind of tech stock style narrative is definitely there. Yeah, Rio Tinto's under a lot of pressure at the moment. Are we going to...
And not great when your haven is acting like a meme stock. Just
No, just to kind of... Yeah, precisely. You've also got Asia out this week, and that has provided, obviously, a lot of impetus into the metals trade of late. So I just wonder whether some of that is coming out of the market as well. But you are seeing the banks back on the front foot. That's been the obvious trade for Europe over... certainly over the last year. Santander's trading strongly, HSBC moving to the upside as well. But it is where we are seeing the weakness in that metal space. What is interesting, though, is that US equity markets actually looking fairly positive. Today we are closed. Tomorrow, futures are pointing to a more positive session, maybe a continuation of the narrative we saw coming out of Friday, which was inflation comes down, the Fed can cut rates, that is good for stocks. But that's not how stocks are behaving at the moment. So let's talk a little bit about what we are seeing with all of this. Natalia Lipikina, head of EMEA Equity Strategy at JP Morgan Private Bank, joining us around the table to discuss. Good morning.
Good morning, guys.
So, OK, we've got a scenario where we are struggling to understand the impact of AI. Sector to sector, stock to stock, huge amounts of turbulence. US equity markets are being hit on the back of this. You think that's the wrong call? You think that US equity markets go higher from here? Why, given all the turbulence?
Yeah, absolutely. Last week was a bit disruptive week because we're seeing a lot of moves, especially in the tech sector. But for us, the most important thing remains earnings.
Yep.
In fact, when you look into the current earnings season, the companies are showing 13% of growth. By the way, this is quite a big number. If you think about the last 5 quarters, we've been printing double digits on the earnings growth, which is quite big, especially when you compare to the previous, average, around 7 to 8%. So overall, this is the reason why we continue to be positive on the S&P. Our target for the year end is around 72 to 7,400. So we think we probably will make new time highs.
Why is the market ignoring earnings?
I think for now, we're so much focused on what is happening in the tech sector because the disruption just happens so fast. The market just trying to figure out who will be the winner, who will be the loser. But if you look outside and think about how much the hyperscalers are spending, we're going to have 600 billion again this year. And that has positive impact on semis, on industrials, on utilities, on such a big portion of the market.
And if you're extremely bullish on tech in the age of AI, that means you've got to be extremely bearish in some other things. What are you extremely bearish on?
I would say the sectors that we're not recommending right now, as a good example, can be staples. If you look into, the market overall, still quite a cyclical move that we're seeing in the market. So staples are not growing as fast, and they're quite expensive. So we don't think that this is an interesting part of the market.
But you also believe in diversifying away from tech to a certain degree. I mean, we can, you might be right about it, but, it's never a straight line up, right? So where are you sort of diversifying into? Where are you trying to find the sort of shelter from the tech trade?
I would say the biggest conviction for us globally actually is industrials. So when you look into what is happening in the industrial sector, massive beneficiary from the AI trade, but also other parts of capital expenditure rising. We've seen very strong backlogs. We're seeing very strong orders on the macro side and on the micro side as well. And we think that both the European and the US companies are benefiting from this trend. Just look into US ISM manufacturing data a couple of weeks ago. Really, really strong print. Actually, the highest since 2022 August. So we're seeing that data already coming through on macro and macro side.
Let's come back to the staples story. Staples are up 15%. Consumer staples are up 15% year-to-date in the United States. Energy and materials have done better. Financials, consumer discretionary, info technology and communication services are all negative for the year. What turns that around? What is the catalyst to turn that around?
I think it's all about earnings. If you look into, for example, the sector that have underperformed this year, healthcare, financials, we actually think that they are in a very good spot this year. I mean, let's look into healthcare, for example, in the United States.
Yeah.
They have underperformed for 2 years in a row because of the, policy uncertainty, but also earnings disappointing. We think that we're now probably at the inflection point for that sector. If we look into financials as well, financials also another great example. Underperformed this year. There was a bit of a dent on deregulation earlier this year, but we think that overall the earnings are still quite solid. Remember, they reported a while ago, a month ago, but overall the earnings actually were quite good. I think what we're just seeing right now is an interesting reflection of the sector rotation and the fact that you shouldn't be just in the tech, for example, right? You want to diversify. If you look into one of the best performing sectors this year in the US, industrials, right, speaks to the diversifications, but also not just the US, but also international. The reason why we're positive on emerging markets, for example.
What happened? If we continue to see this rotation, though, is the index level just going to stay where it is? Or does the index level, you're talking about it going higher. Do we need to rotate back to tech in order to get the index to go higher?
I mean, yes, tech is a very important part of the S&P story for sure. But I think in terms of the tech, we need to distinguish between software and semiconductors. And this is where software may be a bit oversold. There may be some interesting opportunities. But we continue to be positive on semis per se. Because, again, the $600 billion that hyperscalers are spending, semis will benefit the most from that.
Let's hold in the Fed here, because we know which side of the sort of AI trade you are. Which side are you in terms of the two mandates of the Fed are you? Where do you see the inflation picture in the United States, particularly after the print that we got last week? And then again, some of the mixed messages we've got from the labor market in the United States.
Yeah, I would say for the Fed, we expect one more cut this year. So the inflation print was actually fine. We're seeing good data. And similar for labor market as well. We are thinking that actually labor market probably picks up this year. So the economy is still in a very strong footing, so we expect less cuts than the market. So one cut is quite reasonable for us.
And do you have a conviction in a buy Europe trade? Because I think a lot of people wanted to make a lot of the buy Europe trade about a year ago, you know, after Liberation Day and all that sort of thing. But many people I spoke to, it was about just basically diversifying away from the United States. Is there a strong thesis to buy Europe in 2026, particularly with this German stimulus really hitting the road this year, we think?
Yeah, in Europe we have more preference more on the sector level, like industrials, for example. It's a big conviction globally in the US and in Europe. But in terms of diversifying away from the US, we prefer emerging markets. Because in emerging market, you see a very, very strong AI story. Well, in fact, if you look into MSCI Asia ex-Japan, 30% of companies are actually linked to AI. If you look into South Korea, if you look into Taiwan, so there are definitely a more interesting story on AI in emerging markets. Plus, it's not expensive.
Europe can't even get second place here.
No. That's okay. We have other things going on. Why would you buy Europe? Is there an argument for buying Europe other than diversification? Does Europe, to Ollie's point, does Europe stand up other than the fact that it's not America?
I think that is not enough. I think what you need to see in Europe is earnings. And by the way, we think earnings pick up this year.
Okay.
I think there is one risk in Europe. If dollar continues to weaken this year, then you probably may have a very similar to 2025, where domestics still do well because of a very strong, German stimulus. But then the exporters may do as well as people expect them this year.
Where's the line for that? We're approaching 120 now. Where euro dollar, where does it need to get to for that to be a problem?
I think it's above the 120 level, call it 124, 125, which is not our forecast. But
What's
the risk
the forecast?
is this. The forecast is around the current levels, 118, 120.
And I have a question. Where does sort of geopolitics rest in your sort of appraisal? Because I think that in the last 12 months, we got sort of electroshock of geopolitical shock, and now everybody is intensely desensitized to it. Is it something you even think about, or is the market just going to trade through it and not really matter?
Yeah, I mean, we're long-term investors. When we look into earnings, for us, what matters, and basically back to, Guy's first question, is earnings matter the most to us. And when we look into geopolitics, it usually has a very short-term impact on the market, and we're not too concerned about that. But if you think about diversifying, again, gold, something we haven't discussed yet, but this is one of the reasons why we continue to be positive on gold and industrials, because ultimately they benefit from spending that we're seeing in the market.
And how concerned were you by what you saw in the gold trade? Because again, we were going sort of vertical for a couple of weeks, then we came back down to earth. And again, this is supposed to be a hedge, and it's trading a bit like a meme. How much does that concern you?
Yeah, I mean, it was a bit frothy, a couple of weeks ago, but we think that the pullback is quite rational.
But given how much money is in this tech trade, I mean, can the gold market absorb that kind of hedge? Do you know what I mean? Is there just too much money, basically, to be able to climb down from that tech rally?
Yeah, I mean, for us, the thesis around gold is slightly different. For us, it's about, central banks continue to see very strong support and demand for gold. And we're seeing that position is actually fine in gold. So therefore, the current levels were actually happy buyers, I would say.
And you think that carries on? If you see more volatility in gold, the central banks, maybe they continue to buy, but there's been this huge kind of Asian retail trade, and part of that has been driven by speculation, and therefore it stops acting as this portfolio hedge. Do I want a portfolio hedge that has the kind of volatility that gold is now beginning to exhibit?
Yeah, I mean, I don't think it's just, stocks and gold, because ultimately in your portfolio you will have fixed income, you probably will have private equity, private infrastructure, etc. But I think it's absolutely normal to see a pullback after such a huge rally. I think we would be more worried if we just didn't have that. So I think overall, yes, you may have a bit of a more correlation between equities and gold, just given how they have,
Yeah. So what's uncorrelated at the moment? Gold was meant to be my uncorrelated trade, but it's no longer. It's correlated now. So what are there uncorrelated trades that exist out there?
Absolutely. Infrastructure. hedge funds.
But isn't infrastructure just hedged to the AI trade?
No, not necessarily. It depends what kind of infrastructure, because you may have more traditional infrastructure that is less digital. If you think about, ports and roads, they actually will have either negative or zero correlation, or close to zero correlation to the public
market. But a lot of
market.
that, if I buy a basket of infrastructure, there's going to be a lot of...
It's not public market. It's on the private market.
All right. Okay. That's a whole different conversation. Natalia, for next time, maybe. Natalia Lipinhina, Head of EMEA Equity Strategy at JP Morgan Private Bank. Thank you very much indeed. Let's take a look at what we are seeing in the market this morning. This is what the Core 6 looks like. This is the story you can see. LVMH having a fairly good day. You just be aware that I think Hermes has gone ex-dividend today. Defence stocks are fairly flat after Munich, which is interesting as well. You are seeing some weakness coming back into the chips, but not much. Schneider's down a little, but ASML is actually fairly flat. Novo is a little down by 0.4%. So, again, hard to draw a clear line through all of that and get a clear message that comes out of that. So maybe we are focused back on the earnings picture. What are we seeing there? What are we watching with Louise Moon?
One of the biggest stories of the day is Hapag-Lloyd, the shipping giant. Huge deal, buying Zim Integrated Shipping, another shipping giant. So that's about a $3.5 billion deal, only slightly benefiting Hapag-Lloyd's share price this morning, just slightly ticking up into the green, perhaps due to there's a bit of resistance from the unions who work for Zim Integrated Shipping. Also waiting for the deal to come through, expected later this week. Next up, we're also looking at Sanofi, just ticking up slightly into the green. That's after a study showing benefits to infants from one of their key drugs. So slightly ticking into the green for Sanofi this morning. Not a huge boost, but helping them out. Next up, we are looking at NatWest, the UK banking giant. Also a positive day for them, up almost 4%. That's after an upgrade from Citi. They've had strong results recently. There's also been a huge deal as they push into wealth management, buying Evelyn Partners a couple of weeks ago. So a price hike there from Citi. So really benefiting the stock at open. And then UK home builders all into the red. That's after latest data from Rightmove saying that house prices stagnated in February, having boosted hugely in January. So a bit of a stagnation there, weighing on the home builders at open, mostly affecting Barratt Redrow, the UK's largest home builder. And then finally, we're looking at Norsk Hydro down into the red, over 4%. And that's after they were cut to a perform by RBC. So a cut there, weighing also on their share price.
Louise, thank you very much indeed. Louise Moon on